So what do? Well, we focus on what we can control. We're spending a lot of energy on trying to prop up the local economy because, as Michael said, jobs are everything. It drives everything. We have a very far-reaching plan that's focused on everything from accelerating capital spending to creating tax credits for new jobs, local equipment purchases, microloans, et cetera. We think in the long run, the opportunity that this crisis presents is an opportunity for structural change in the way San Francisco views business and development. But to be perfectly frank, I'm not sure the political will is there yet. I think it's going to have to get worse before it gets better. We are trying to do some things to address marginal cost issues around development, things like deferring some of the impact fees till TCO. Even something as radical as perhaps property tax rebates for certain types of construction if you go into the ground soon. But I'm not sure that that's enough to move the needle. I don't know that even those marginal cost measures would prompt new construction now, but it may help nudge a project a little sooner than it would occur otherwise. So we're going to push on some of that. One of the interesting things that we've seen is that even though new construction has fallen off a cliff, we are seeing that our development partners are sticking with us on entitlements for long-range big projects. So everything from Treasure Island to Hunters Point Shipyard within the Trans-Bay planning area to Visitation Valley, Park Merced, folks are spending a lot of money on long-range entitlement planning. And I think that is fundamentally a reflection of the long-term economic fundamentals of supply and demand in San Francisco, and that they are good. I think that public-private partnerships are going to be more important than ever, principally because of the ability for cities to bring tools like tax increment financing and Mello-Roos as a gap financing tool to help deal with some of these fundamental imbalances in the market. And then finally, you know, Tim said to me, you've got a friendly audience here, talk to them about what they can do to help. And I think the key is engage, engage, engage. There is a political process that goes on in San Francisco that you well know about. And all too often, the voices of reason around development and the business community are fractured. And you know, it's an old axiom that warring factions come together with a common enemy, and we have one, which is a real economic crisis. And I think in this time, the differences between labor and business, between small business and big business, between environmentalists and developers, are all overshadowed by a rather common set of interests in our desire to keep San Francisco a vibrant place. So I would really urge all of you to take this seriously and to engage in the process, because we do have an opportunity to make structural change, but I'm not sure the will is there yet. Thank you.
Fantastic. Actually, fantastic. I'm surprised and delighted that you were able to make a silk purse out of this sow's ear. So thank you very much, Michael, for that. All right, my friends, shall we turn to the unanswerable questions, like, will the $2 trillion being devoted to the purchase of toxic assets have any significant impact whatsoever? I see a knowing smile from Steve Fain.
Well, I will tell you, Roberta, that Michael and I had a little conversation about that this morning. You know, you have money that is potentially kind of floating out there to assist in this purchase, but you got to have a willing seller and a willing buyer, and there is a total disconnect between banks, and I'm not naming any in particular, but banks realistically whether or not banks have realistically marked their assets appropriately and are really going to fess up to what they're worth. And if you looked at those of you that read the Wall Street Journal, if you looked at the Journal this morning, the accounting rules with respect to how you mark those things are being reevaluated, and they're basically going to let the banks say what they think they're worth again. And they're not a bank in America or abroad that's going to say, well, you know what, I want to market lower. So, and I don't think there is a buyer in America that's willing to pay what a bank thinks it's worth. So, you tell me.
It might be useful to explain this sort of program that's out there to allow, that the Treasury Department is setting up to potentially be buying these assets from the banks. And there's a lot of talk about, when you read the sort of mainstream press, about the fact that the federal government's taking a lot of risk, and Krugman's come out and said it's a bad deal for the federal government and such. But what it basically is that you have a private investor has to come up with 5% down, and the federal government will come up with 5% down, and the federal government will finance the rest. And to the extent there are losses, the initial losses are suffered 50-50 between the private investor and the federal government to the tune of the first 10%. And then after that, the federal government suffers the risk of loss. So, so while the federal government takes significant risks, private investors have big risks too. And what Steve is saying is that for a private investor to come up, put their 5% at risk, they're going to then bid theoretically on these sort of portfolios. And the question is are they going to bid enough for a bank to say, I'm willing to sell the asset at that price? And I would think that generally speaking, if a bank can sell the asset at a price greater than on its books right now, then they would to this new buyer. And if the price that the asset is on their books right now is higher than this potential buyer, then a bank isn't going to want to sell, because all it's going to do is bring down their net equity. And that's where it's going to be interesting to see as this sort of unfolds, will the buyers be willing to pay a price that the banks want to sell? And it would be nice if the answer is yes. And I think I fear the answer is no.
How long will it take us to learn the answer?
Here's the problem. You've seen the absolute meltdown of the single-family market.
Yes.
The commercial market has basically held up to date. There are tremendous, but there is huge deterioration in folks paying rent to their landlords.
Right.
So that you need the rent to pay the debt, and that debt's been securitized, and we've not seen the true fallout yet on the commercial side in the CMBS world. And folks that think they're holding on to AAA paper may not be. And I do fear that there's one more shoe to drop around here, which is commercial real estate.
And that will drop in 2009, 2009
I think
to 10?
I hear it. I hear it. And I think it by the end of this year, you'll have some massive issues. My economists may.
I think that's right. I think there's maybe a little underestimation of more deterioration in the residential housing sector. I think there are more shoes to come there. In particular, the option arm thing is going to blow up towards the end of this year. And then there's prime. There are going to be foreclosures in prime because people who are otherwise creditworthy are losing their jobs. And there's a big lag between when the job loss occurs and when foreclosures result from that, because they can hold on for 6-9 months. I think that this plan has an opportunity to help. We can leave aside the question of whether or not it's a good idea or the best way to help, because it's going to be very expensive for taxpayers. But it will help over the next year and a half. I think it's just too soon, because valuing these assets is still just too hard, because nobody knows where the bottom is in residential and where the bottom is in commercial. And so, although the risk is somewhat minimized by the fact that they're non-recourse loans, still it's hard to make the jump into the water.